And it is great to be here with you, Doug Peterson. And I want to start with the kind of general view of the markets, which you spend a lot of time thinking about, I imagine, both the stability of the market and the risk of these markets. We're in somewhat strange times. So high level, what's your thinking about where we go from here?
Well, Amanda, thank you for having me here today. And talking about the markets, let me start a little bit with the credit markets. We've seen this huge rush to raise liquidity for corporations, especially investment-grade corporations that want to have the liquidity on their balance sheets. At the same time, we're also seeing a rebound in the equity markets in the United States. And I think there's a few underlying conditions there. First, there's a lot of capital flowing to the United States. It's coming from around the world. The United States right now has, even though the interest rates are so low, the base rate is still one of the highest in the world. Today, the 10-year rate in the US is 80 basis points. In Japan, it's 1 basis point. In Germany, it's negative 30 basis points. In Canada, it's 60 basis points. So we still see a high interest rate here. There's belief, I understand that there's people that think that there will be a vaccine maybe earlier than expected, maybe by health professionals. And so there's some also some hope that the markets will come back, et cetera. So there is definitely a lot of risk. There's a lot of unknown. But when you look at the credit markets, you look at the equity markets, they've been very buoyant, especially in the last 2 months.
And when you look at that, does it feel healthy to you? And let's focus on credit for a moment here. We know, obviously, that there are a lot of businesses that need capital. I guess it's inherently healthy that they can raise it in the private markets. Having said that, we also know before COVID that there were some concerns about parts of credit, right? That there was a deterioration in quality, covenants were maybe thinning out a little bit. I wonder where that went in light of this kind of rush to recapitalize here.
Well, using some of the statistics from our rating agency, we went into this crisis very different than in 2008. And as you said, credit quality was actually lower. I want to call it the median credit level in 2008 was BBB, and now this time it's BB plus actually. And there's also been a very large amount of issuance of single B credit and lower, especially for leveraged loans and for the sponsor world. But the thing is that the markets know that. They understood it when they got into it. They got pricing for it. We're seeing an increase in downgrades of that, especially that low credit quality. It's the area that we see the most downgrades. So far of the downgrades we've done since the crisis began, 85% of them are in the lower quality credit. And then there's some in the investment grade credit. About 15% of the downgrades have been in investment grade credit so far. But I think that the investors went into this with their eyes wide open. The credit quality is definitely lower. There is risk. We've seen the sectors that we would have expected to see higher levels of risk and downgrades and defaults have been the ones that have defaulted. So right now the markets are playing out as we would have expected. One other comment I want to make, very different from 2008. We've gone into this health crisis with the banks in very strong positions. The banks have strong capital. They have capital buffers. They have liquidity and liquidity buffers. They've been going through stress tests for many, many years from a much more robust regulatory regime. So right now, this is one of the things that's very different from the prior crisis in 2008, that the banks are in such good shape.
Different and, of course, very stabilizing. One other difference we could note, and I'm curious for your thoughts on how it's affecting credit, is the role of the Fed. Obviously, the Fed reaching, as the ECB has done, into new markets. Now, maybe the greatest jawboning of history is the Fed's promise to buy bonds, because it hasn't done a lot of it, but buyer of last resort. So my question to you is, do we see the spreads responding the way you would expect them to respond when we see the downgrades? Or is that backstop by the Fed affecting the market in a way that concerns you?
Well, the spreads are acting as I would have expected, because the Fed and the ECB, both of those two programs, they're really meant to support liquidity, not credit quality. They're not backstopping in the sense that they're going to step in and bail out companies. The bailout programs are actually through separate programs. They're through programs in the United States. The Fed, it came through the fiscal approach, through the government. The Congress came up with programs to support certain industries like airlines, to ensure that they had the capital to continue to operate. It's a critical industry for the United States. But the Fed's programs are actually to support liquidity in the market. So far, it's interesting, they haven't bought any bonds. Just by saying they were going to do it, It has helped support the bond market. They have bought ETFs, they have bought some mortgage bonds, but they have not gone out and bought a direct bond themselves so far. And there's been so much liquidity in the market, they didn't need to do it. But you're absolutely right that the Fed and the ECB have played an incredibly important stabilizing role right now in the markets.
You know, when you laid out in your recent quarter your the kind of three scenarios, the base case is for third quarter sort of stabilization. Give me a sense of what goes into the mix there, because when we talk about kind of the unknowns, you mentioned a vaccine, for instance. We really don't know whether we get a vaccine soon or if at all. How do you factor that level of uncertainty into a business like yours, which really does dwell in the, in the certain? You like numbers, you like analytics. How do you deal with the forecasting when it's so hard to say?
Well, you're absolutely right about the uncertainty. And when we went into the last quarter and we were preparing our analysis for our guidance, some companies had just said they weren't going to do guidance at all. And we took a step back and said, well, we have in our own company economists and experts in the oil markets, experts in credit and the equity markets. We should actually eat our own cooking and use the experts that we have in our company to build our own guidance. We looked at all of the different key factors that drive our business generally, GDP growth. We looked at the oil markets. We looked at the credit markets. And we then looked at what we could learn from the health experts, the epidemiologists, about the timing of this. And those are the factors that we took into account. Generally speaking, our business is quite resilient and we have a strong balance sheet. We have a lot of liquidity, but we're also subject to all of those different kinds of risks. Unemployment is one that we're watching very closely to see how governments are going to support the unemployment markets, to see what will that have to the economy. One area that's the hardest for us to measure is the small and medium enterprises. And small and medium enterprises are not necessarily our clients, but they're so important for the underlying economy. There's so much job creation there. And it goes all the way from restaurants and small shops and barbershops all the way to small suppliers for those kinds of industries as well as large industries. And that's an area that's a big unknown for us, so will also have a big impact on the economy going forward.
And what are you watching there? Because to me, that is sort of one of the things where we've seen confidence and optimism where there had been a lot of pessimism. That's to say, this notion that this, unintended lockdown of all of our economies would, rather than the V shape we all hoped for in the early days, become this protracted thing precisely for that reason. Businesses simply wouldn't survive this period. Big businesses might, small businesses wouldn't, and that's where the job creation happens. Are you feeling more optimistic that even for those that don't survive, there will be new ones, that the jobs will be created at a pace that will keep the economy buoyant?
Well, right now, one of the most important factors is what's going to happen, at least in the United States and Washington, with the programs to support unemployment, to support small companies so that they can stay in business and keep jobs growing. And we will be watching that aspect very carefully. So the unemployment statistic becomes for us one of the, even though it's a lagging indicator, for us it becomes a critical indicator to understand what we can see with the business recovery. There's also other ways that the government can stimulate the economy. Infrastructure is one that takes a longer time to get in place, but it also is more sustainable in the long run. So these are some of the programs we're watching very carefully that will come out of Washington as they look at ways to stimulate the economy.
I want to ask you about China, and for you, China, of course, happens, I think, on kind of two levels. There is the business opportunity for S&P there, which seems enormous. And there is also, of course, the kind of macro trade geopolitical issues that predated COVID that are seemingly worsened. Globalization and kind of interconnectedness and cooperation seems to be worse today than it was 3 months ago. So your perspective on how we emerge from all of this?
Yeah, so two aspects to that. On the China equation, there is definitely an increase in the noise around China. I think it's partially political. Some of it is pushback from the health crisis and some of the supply chain issues that have cropped up. But at the same time, we see for our own business, but also in the financial markets, a real resolve to continue with the reform of the financial markets in China. I think that the central bank and the other leaders in the financial markets know they have an aging population. They want to continue to be part of the global capital supply chain, even more so than they are now. And so we see that this resolve on the financial reform continues forward. Just recently, some of the banks, foreign banks, were given licenses to own over 51% of their operations, some all the way up to 100%. So that's, for us, something we watch very carefully in China. But I do think, to your question, there will be more tension around trade. And it's China trade with US and other parts of the world. As we know, Brexit's still not resolved.
Right.
Brexit is something that we still see hasn't resolved. People aren't talking a lot about it. There also are trade pacts between the US and Europe, others around the world, that we need to look at. So there's definitely, with the populism, with the current environment where people are looking inward to recover from their health crisis and the fiscal crisis that's hit them, there's a lot less international cooperation. But at the same time, if you think about the way the world works, we are totally interconnected. Anybody who's drinking a cup of coffee, it's likely that coffee wasn't grown in the country that they are drinking it in. And so there's so many different types of products and services that are required to have this international cooperation for them to trade. So I think that there will be a need on the business side to keep pushing very aggressively towards this international cooperation.
On the business side, there's also a very strong sense, I think, that this is a bit of a pivot moment, and we see it in different ways in different places. I think. I mean, here in Canada, of course, we are seeing our energy sector having a real sort of hard moment of, is this the pivot towards a more sustainable kind of a future, and what does that mean? But across the board, businesses are suddenly, it feels to me, many have been doing it for a while, but a lot of them focused on ESG in general and getting very kind of specific that they can use this moment. How do you see that playing out? And is there an investing opportunity in this as they kind of start to rethink what they're doing?
Yeah, the ESG movement had started well over 10 years ago in the Nordics and Northern Europe. But in the last couple of years, it's really started to become much more mainstream. There are over 2,500 investors who have signed up to the United Nations Principles of Responsible Investing, and they control $90 trillion worth of capital. That doesn't mean that they're investing all of that capital yet into ESG strategies, but it's an indicator that the markets are heading in that direction. We're seeing a lot of interest in the kind of information that we're providing, in the sense that people want to see more granular data about environmental and climate impacts, about governance impacts. And to your question right now, as people start building a conscious about this and building it into their business processes, the S factor, the social factor now, is really increased in interest and importance in this crisis, because you think about what the S stands for a company. It stands for how they treat their employees, how they work with the communities, how they think about their supply chains. And just right now in the United States alone, we have this terrible situation with the death of George Floyd and the other unnecessary deaths that came before that, and an increase in social consciousness inside of companies. And so we expect that there's going to be an increase in interest in ESG. And right now is a point in time where the increase in S is definitely going up.
And we had seen that, quite apart from, to your point, the really kind of historic events that are unfolding, starting in the US, but really around the world in some ways. But from the business side, the Business Roundtable had adjusted its kind of core principles away from simply the investor and profit to the broad stakeholders. This feels like a movement that had begun before. The question always is, and it certainly will come up in the context of sort of discrimination and how we address long-standing problems. How much of it is lip service? How much of it is nice words and gestures, which can be important. Words and gestures are important, but how much of it is really meaningful? Do you feel like the business community, especially in the US, is really taking this on board in a different way?
Yeah, this is definitely one of the most interesting times I've ever seen when it comes to this issue. We're seeing companies really step up. At the Business Roundtable itself, as you know, last year had redefined the definition of a corporation to think about stakeholders. And it goes beyond just your shareholders. the purpose of a company is obviously to survive, but in order to do that, you have to treat your customers and your employees and your communities with respect. And this is a period where that's even more important than ever. The Business Roundtable has actually formed a new committee to look at how we can address the current concerns around racism and diversity and inclusion as a reaction to this. Our own company, we immediately went into action and started listening to our employees, listening to our Black employees in particular, and we came up with an action plan that we've talked about publicly, how we're going to invest more in diversity and inclusion, how we're investing through our foundation in organizations that support communities around the world and in the United States. We're going to increase the way we think about our employee resource groups. We have really active, very high quality employee resource groups. We want to do more there. And so we've been thinking about this and listening the last couple of weeks. We're going to listen a lot more, but we decided we needed to spring in action ourselves.
And so just, I mean, obviously this is a time when a lot of businesses are still, we can't gloss over it, although there's these kind of green shoots of improvement. This is still a crisis around the world from a business point of view, for people and their jobs, economically. I mean, communities are going to be feeling this for many months to come. So just give me your sense of reasons for optimism here. There's lots of reasons I think that we could talk about pessimism, including, the ones that we really don't know and can't control, like a second wave of a pandemic. But reasons for optimism from where you sit?
Yeah, first of all, I think that there's optimism around the way that governments, in particular central banks, have reacted. The central banks were the heroes of the last financial crisis, and they're stepping up again. And they're continuing to provide liquidity to the market. So I think there's optimism that there is the ability to really move fast and create ways that the governments can step in and support economies. We talked about the importance of the corporate action that's starting to take place and the consciousness in corporations for ESG and the social good that they play. There's also something I think has increased is the knowledge of and awareness of the value of public and private partnerships and how the public sector and the private sector need to work together. Look at what's happening with the speed of the vaccine that's being developed in many different countries and many different companies. That's coming from the private sector, but in order for the private sector to do that, they need to have this cooperation with the public sector. So I think that there's some really good lessons that we're learning, and I hope that this will go even further into what we talked about earlier, which is the interconnectedness of the global economy.
All right. Unfortunately, that's all we have time for. Thank you so much for this, Doug.
Thanks, Amanda.